Tom, let me turn to you and ask you to share your thoughts on this overall issue, and particularly focusing on global implications and perhaps even what the multilaterals are. What's the thinking there in terms of how to deal with this process, if that is necessary. Yeah.
I should say that I worked on China for the IMF crisis. Haven't worked on it since then, so I don't really have so much direct experience working on China since then. Although I have been following, of course, the debate both outside the IMF and inside the IMF, so I have a little bit of a sense of what the discussion is about. We just published our most recent annual report on the Chinese economy about 3 weeks ago, so on the 14th of August. So if you go to the IMF website, you can get the most recent thinking on how we see the Chinese economy. And much of what I'm going to say is kind of reflective of the debate, the discussions that we had with Chinese government at that time and subsequently in our board. As Ajay said, I mean, there has been a slowdown in growth over the past couple of years. Despite the volatility in August, we continue to think, at least at this point, that the growth forecasts we have for this year, for 2015, which is about 6.8%, and for next year, about 6.3%, will hold up. Those are slower growth figures than in the past. We had about 7.4, 7.5 last year, so there is a slowdown taking place. Obviously, in the past, it was much, much higher. The one point I would make for for India, I think, is that, although we have, even within India, had a lot of discussion about the national accounts and the new GDP statistics for India. So it's not just China for which we have a real debate about how much we can rely on statistics. I should say that even if you go back to January, at the fund, when we were making our forecasts for 2015, 2016, and the medium term, we already had India growing faster than China even before the CSO revised its GDP series. So the one I think big picture point to make is that India has shifted to be the fastest growing large economy in the world, and that was true even before the most recent GDP revisions here. So that reflects, as Ajay said, a kind of a bit of rethinking about how to drive growth within China. There's a bit of a strategic shift going on towards a slower, steadier, more domestic consumption-led model of growth rather than an investment-led model that is, especially over the past few years, has been very heavily financed by leverage and sources of financing that are on the I don't want to say dangerous side, but certainly, we're leading to giving cause for concern. Stock market boomed at a time, that total financing within the economy was growing extremely rapidly. And as Ajay suggested, that for at least for people like me who are, as you can tell from my outfits, just by nature very conservative, that level of financing really, makes you nervous about the quality of the lending. And so the fact that there's been a correction and that we're sort of reestablishing some equilibrium is probably a good thing as long as it can be managed well. And I think that's, as Subir mentioned, that's I think the concern, that we want to make sure that this adjustment is managed well. I think if you look at Chinese policymakers over the past 20, 30 years, we've almost come to the view that they're infallible in a way. I mean, they have had such a long run of getting it right. And in fact, I will say that when we go back to the late 90s when I worked on China, we were really concerned at that point that the big push for infrastructure investment, particularly away from the coast, inland, was likely to lead to a lot of white elephant projects. And we were pretty explicit that we thought that this was really dangerous for them, that they should tone it down. And they said, no, we think this is a good gamble for us. And I think in hindsight, 15-year hindsight, they were right and we were wrong. Certainly they got a lot of things right over that horizon that, if they had followed our advice, they might not have. But I do want to mention that or emphasize the point that being more assiduous about financial sector regulation, reining in the shadow bank financing boom that took place, is a tricky thing to do, but in the long run healthy if they can manage it. And they are taking some steps. They've taken steps to bring that under control. A lot of the lending in China and a lot of the activity, I would say, ultimately is somewhat fiscal in nature. So a lot of the entities that were borrowing and were engaging in infrastructure projects were in some sense connected to or are part of subnational governments. And so, and there's a broader measure of what's fiscal in China that would lead us, although I have complained many times, including in this room, that India's fiscal deficit is out of line with comparators and so forth. If you look at our last report on China, there is in one sense, a measure of the broadest, augmented measure of the fiscal deficit that in China is bigger than in India, at almost 10% of GDP. So bringing that down gradually is important. I think since Ajay raised it, I'll spend maybe the last minute or two talking about the exchange rate issue and what's happening there. I don't have any special wisdom on this. I'm not part of the discussions around the possible inclusion of the renminbi in the IMF's SDR basket. So I don't have any special knowledge. Although I know that discussion is going on. It's not concluded. It'll take another several months before the end of this year at least, and it could even take a bit longer. So that whole debate is ongoing. Although I'm pretty convinced that the moves that they took to introduce greater flexibility in the exchange rate are ones that we welcomed and are ones that in the long run are consistent with the broader financial market, gradual capital account liberalization moves that we think are probably likely in the long run to lead to a better outcomes for China. My boss, Madame Lagarde, said that it's not a question of when and of whether the renminbi gets included in the SDR basket, but just a question of when. And I think that makes a lot of sense, given that China's trade and trade denominated in renminbi is already a very substantial fraction of global trade. It's just a question of whether that renminbi is adequately freely usable for the purposes of the IMF members who use the IMF their holdings of IMF currency. So at this point, I think we don't see this as being directly related. The move in August is being directly related to that discussion, although it's consistent with our advice over time. Finally, if I can just finish on 2 points. I mentioned the fiscal outlook, and I do think that since we've made for kind of equal treatment, deserves some comment here. As I say, we've talked a lot about the large fiscal deficit in India, 6.5%, 7% of GDP at the general government level, as being too large and ultimately a potential source of vulnerability for India. For China, an augmented deficit, basically a fiscal deficit that includes the on-budget deficit of about 2% of GDP, and then everything off-budget, which when you package it all together, and of course there's a lot of uncertainty about this, there could be some double counting, but one measure that we have reported puts it up in the neighborhood of 9 to 10% of GDP. Deficits of that order have to be financed. That level of financing creates vulnerabilities down the road. And I think in some sense the adjustment that we're seeing is reflective of those vulnerabilities. A lot of the infrastructure projects at subnational level were financed by vehicles that had some additional risk that I think is a concern. So that's a question, and I think for us all, not just people in China but outside China as well, it's important that the authorities get this rebalancing right. I think they need to gradually deleverage and reduce these vulnerabilities, but not do it so fast that they actually create instability and excess bumpiness, right? You don't want the landing to be so hard that the wheels come off, but at the same time, if it's too slow, these things tend to creep up and build up again. And then finally, but not unrelated, and it's also something that we might think about a little bit in India, the large public enterprise sector, the SOE sector in China, is one where, if I think back to the discussions that we had with Chinese government 15, 16 years ago, in a way, we're pretty blunt about the need to reduce those vulnerabilities and to gradually bring that sector down and modernize corporate governance, maybe, divest more rapidly. It's clearly similar to a discussion that we had also with the Indian government about the size of the public sector, particularly in the financial sector. So I do think, for India, and maybe this is the final point, Ajay's graph that shows India following China with a 13-year lag. I would hope that India could learn from these vulnerabilities in the public enterprise sector before they build up to the Chinese level. So we have 13 years to go. We should maybe use those 13 years to kind of unwind that bubble before it bursts in our face. Okay, so I'll stop there. Thanks.
Thank you, Tom. You, I think, led into Rahul's theme that he's been writing on, which is this, great transition from the sense of infallibility of the leadership to now almost, overnight sense of loss of control and not quite knowing what they're doing. That may have its own dynamics in terms of both global outcomes and domestic ones. So Rahul, let me ask you to share your thoughts, and then we'll sort of open it up for discussion.
Okay. After those very comprehensive analyses, I feel a bit daunted. In the past few weeks, it hasn't seemed that strange. You've actually had, for several months now, the Chinese state media egging people on to invest in the stock market. And the stock market is actually maybe down 40%, but it was actually up 150% all the way through June when the bubble finally burst. So there could be nothing more irresponsible for a government to do with plenty of poor people investing their savings than to encourage and exhort your average person on the street to invest in the stock market. It was downright irresponsible. And they've continued to do it through this crisis. So to Tom's very good point that the infallibility bubble has burst on Beijing, they've actually burst it so spectacularly that even as one a journalist gets into a slightly naturally antagonistic position when you're covering the Chinese government. And I've sort of waited for this moment, I have to confess, because I got so tired of investment bankers in Hong Kong and not a few people, businessmen in India, saying, what really works is dictatorships. And that's basically what you need to solve economic problems. And what this proves spectacularly is that dictatorships do things incredibly badly sometimes and under pressure. So on August 11th, which is when this devaluation took place, and essentially it was a move to free up the renminbi. I don't think it was driven at pushing up exports. This is widely misunderstood, and actually being in and out of factories in southern China helped me understand that. Labor costs, even in garments, are actually a small fraction of the total cost of a product. So even in garments, which is very labor intensive, labor costs are about 20%. The depreciation, devaluation, whatever you want to call it, is a total of 3%. Labor costs year on year have been going up 12 to, in about 5 years ago, even went up by close to 20% in southern China and in China generally. So in the scheme of things, this devaluation isn't such a big deal. But the way they've mishandled it has made it a huge deal. So on August 11th, on August 11th and thereafter, actually we're now exactly a month from that date, we haven't seen the People's Bank of China governor in public since August 11th, which is a staggering fact. I mean, imagine having this level of volatility and Raghuram Rajan going into hiding or playing squash or whatever he does when he isn't, making public comments. It would be unheard of, and so no one has any idea where he is, and he's actually a very capable central bank governor. So there'd be no communication on what was essentially an attempt to free the currency a little bit. The President Xi Jinping on August 11th made a comment attacking Tibet and the Dalai Lama. Li Keqiang, the Prime Minister, made a comment about China's opportunities in the 3D printing industry, which sounded like he was at a trade show. They've gotten a little better in the last couple of days, but they haven't exactly covered themselves with glory. And then there have been these repeated interventions into the stock market, controls on derivatives traders, interrogations of securities traders, including of their own large Chinese security trading companies. The head of the, I think it's Man PLC, large hedge fund, UK-based hedge fund, the head, Lee Yifei, has been taken into custody, and at least a week ago, her husband didn't know exactly where she was. So this is, classic heavy-handedness on the part of Beijing. And it doesn't really build confidence. It does just the opposite. If you reduce the opportunities to short, and you're essentially eventually taking liquidity out of the market if you're constantly asking people, large state-owned companies, not to sell. All the foreign investors and other people start to panic. So that is what's happened. So in terms of image management, it's been as close to shambolic as anything I've seen in New Delhi, which is actually much worse, which has been a separate kind of consolation. But the other side of this is, I think that because of the headlines and because of the huge drop in the stock market, we may be in danger of overreacting to it. And while that may seem contradictory, I think that what is in the near term actually a 40% correction, but coming off a 150% rise in the stock market, shouldn't overshadow that consumption is still growing at about 10%. The CEO of Samsonite, who happens to be Indian by coincidence, was raving at their recent results about sales in China, which were up 20%. Tim Cook of Apple was talking about how it's the largest market in the world, and in a what someone called a kind of Henry Ford moment, the largest market for apples is in fact the country that is assembling them, China, as of this year. So all of those things are indications that the consumption rebalancing you were talking about is proceeding, but of course it should be further along. The bigger challenge in the long term, it seems to me, is getting that rather horrific graph that you showed of investment as a percentage of GDP, getting that from 40% plus to something more sensible for an economy growing realistically at 4 to 5%. And when that happens, and doing that gradually is really going to determine whether China does face a crash, the real economy faces a crash. Because if investment, and it's already coming down in cement and steel quite dramatically, but if investment has to come down, and it does, logically, if you're growing at only 4%, has to come down quite dramatically, how you balance that is going to be critical in terms of future economic growth. So I think in the longer term, actually, it's trickier. In the shorter term, unless they panic, and really on the evidence of the past few weeks, who knows what they're going to come up with next. If you're interrogating stock traders, short of taking the CEO of Morgan Stanley into detention in Beijing, it doesn't get worse. So if they kind of keep a steady head, there's no reason why the economy should go into a complete tailspin. But I think in the longer term, getting that investment to GDP ratio down is going to be a real challenge.